Joining us now, BlackRock's Global Chief Investment Officer of Fixed Income, Rick Rieder. Rick, we're looking for 2017 to be higher interest rates and higher growth. Is that your forecast as well?
Yeah, I think it is. There is a dynamic at play that you're starting to watch play out, where the anticipation of, people talking about fiscal and infrastructure, and you know what, that will come. However, the markets are going to start to price in and are pricing in the tax influence. The tax influences are significant. When you talk about marrying corporate tax, the personal tax, the repatriation, how the debt markets, we've lived in a world for the last 2 or 3 years that it's been borrow, buy back your stock, borrow, buy back your stock. You're going to change the tax shield for companies in terms of, the benefit you get from borrowing is not going to be as significant. And the cost of the debt's going up. So what happens now? Companies are going to have to start investing in their business, grow their market share. It's pretty exciting stuff. I mean, and this is, quite frankly, for being in the markets, as opposed to 2 years of, are they going to go September, December, and it's at 25. Now you've got divergence across markets. Now you've got some enthusiasm. And quite frankly, you're seeing animal spirits. You're seeing company surveys improve. You're seeing personal confidence surveys improve. So, yes, what does that mean? It translates to a bit higher inflation, bit higher interest rates, but some pretty good markets.
Yeah, I'm glad you said animal spirits, because I feel like we are seeing animal spirits
100%.
in a lot of areas in the market. I did not see animal spirits from Janet Yellen last week.
Agreed.
What is she looking at that we're not looking at? And how do you react to the Fed meeting and raising of interest rates?
So, but first of all, it was surprising that they were a bit more hawkish than expectations. However, like you said, Chair Yellen, I think, as she said this in the last meeting, listen, I think the biggest day of the year was September 21st, where the Bank of Japan, Kuroda, came off of negative interest rates, allowed the yield curves to steepen, helped the banks, helped the insurance companies. Chair Yellen then came out and said, we're going to let the economy run hot, we're going to let it run hot, we're going to let it run hot. And then you think about what she's doing now, there's uncertainty, meaning we don't have to be that fast. We can be behind the markets, let inflation run a bit hotter, and let the economy run. And particularly if you're hiring more people, wages are growing. And, the Fed, when you enter a tightening cycle, different than when you're easing, the Federal Reserve is always behind the market by, about 6 months. And I think exactly what she articulated was we haven't seen it yet, and we could give it a bit more time. But there are others on the committee. This is why we moved from 2 hikes to 3 hikes expectation to dots that we all focus on. There are others on the committee who are anticipating either growth faster or they could start accelerating the program a bit faster.
So what do you think? What does Rick Rieder think in terms of the number of hikes we get next year?
So listen, you think about where we came into this year, it was going to be 4 hikes. We got 1. And you think about, and I think you said it earlier, that, in I think it's 64 meetings, they've moved twice to move interest rates. So, listen, I think the betting line, while they're suggesting 3 now, we think growth is going to be better. I still think the Fed's going to be behind. I think it's 2 at 3. If the economy picks up faster, you bring March onto the table again, and then you can get the 3 hikes. But I still don't think.
You said we're not going to see a lot of rate hikes. And
I'm going to take the under on 3 for 2017.
I want to get back to really whether or not this is possible, what Donald Trump is trying to do. I mean, when we spoke with Steven Mnuchin, incoming Treasury Secretary, he predicted 3.5% to 4% economic growth. If you're talking about 4% economic growth, that's a different scenario for the Federal Reserve and higher interest rates. Do you think that's achievable in the next 2 years?
So there's a lot of low-hanging fruit to create greater growth in this country. I'll tell you the big one, and the big one in terms of how you get there is you think about what's really been culling the growth of the economy. It's been financial transmission. There's this view, we keep rates low, banks will lend, small business will grow, just not happening. Now, you're creating a dynamic that even with rates a bit higher, you can still create financial transmission and velocity. We call it, traditional economics, you need velocity. You can grow the money supply, but you need the lending mechanism. Now the lending mechanism is picking up. So yes, I do think.
Yes.
I think you can create that growth. I think you can create that growth. Taxes, a bit less regulation, more velocity, more this financial transmission. You can. Now, is it all going to come in the first quarter of the year? No way. And there's going to be ebb and flow of, this number was a bit disappointing. Retail sales we just got, not that great. The trajectory is pretty good. And yes, it's achievable. And I think, as you all talked about earlier on your shows, I think the dynamic of having unified government, whether it's Republican or Democrat, we can actually get some initiatives through that Bernanke's called for a long time. We need fiscal. Actually, we're going to get it.
Yeah. Rick, I got to ask you this before I let you go. I've always said the bond guys are smarter than stock guys. So what does the bond guys say about the stock market for the next 3 years?
So I often, people now regard me as the most bullish on stocks, and when the bond guy is bullish on stocks. But I do think stocks are going to be in good shape. I do think, yes, I respect the valuation argument. However, if you take corporate tax and you bring it down and you think about, where are we going to take corporate tax? Let's say it's 20% or so. The earnings per share benefit for companies like financials, healthcare, is extraordinary. You can lift
20% earnings?
Actually, we've run it. You can run almost 25, 26% growth of earnings per share
At a 20% corporate tax rate.
You can draw. Certainly you can do it, and in places like healthcare, places like financials, et cetera, it's pretty powerful. By the way, you think about how companies react to, boy, I've got better cash flow coming in. I know my earnings are going to be better. I can take a bit more risk with my business in terms of now I can spend on CapEx. I think there's an enthusiasm that I think is justified. Again, a lot we got to see come. And by the way, global growth is not great. China is got risk. There are risks out there, but I do think the enthusiasm and momentum are justified.
Well, just like you want to listen to Maria on election night, you want to listen to the bond guy on the stock market. Trust me, Rick, thanks for coming in today.
Yes, sir. Thank you.